Hi guys, this is Dean. Today we're going to look at the factor analysis tab on the market dashboards of Koyfin. Before we start, I would like to let you know that you can get 20% off Koyfin plans in the link in the description. So in the market dashboards of Koyfin, these are the pre-built dashboards that you have on the left side here. We have a few of them. We're going to look at the factor analysis one today. So you can't basically edit these tabs, but they're pretty good already. And if you don't know what factors are, it's basically another dimension to group stocks together in terms of, or as opposed to the traditional groupings such as sectors or size. Well, actually, we do group them by size here, but not by sectors, industries, etc. So factors is basically a bunch of ETFs, okay? We will see that we're using the BlackRock's, or Koyfin is using the BlackRock ETFs here. And what they're doing is they're comparing it to the SPY. So actually, the charts on the screen are not the actual value or performance of each ETF. It's the performance relative to the S&P 500. So there's a big difference there. When you're looking at the chart, this is not how it would have performed if you owned these ETFs. It's only showing how it has performed in comparison or relative to the S&P 500 here, okay? So we have different styles of ETF. As you can see on the left here, we have growth, value, momentum, small cap, low volatility, and high dividend yield. So what are those? First of all, growth. Growth is usually the tech stocks, right? It's the stocks that have high promises, high expectations for the future, usually no dividends, and mostly tech stuff where it's supposedly will have a lot of growth coming in the future. So these, you could potentially put all the AI stocks in there. And if we look at the 10-year chart, this is the red line. We can see it has, over the last 10 years, outperformed the market, the American market, the S&P 500 by 30%, which is pretty significant. Let's reduce it a bit, maybe to 5 years. We're at plus 16% over the S&P 500. And since January 23, it's really at that point there was a downtrend since 2020, or there was a big rise in after COVID, but then a downtrend, slow downtrend until January 23, and we're back up since then for growth. Now all the others have underperformed the S&P 500. What do we have? We have value. So value stocks or value investing, it's basically discount shopping, right? Looking for bargains. So these are the companies that have low P's. Like the Warren Buffett method, if you will, or Ben Graham more accurately, because Warren Buffett kind of switched and wasn't necessarily all value investing after a while. But in his beginnings with Ben Graham, he was a value investor. And so this ETF represents, stocks with low P's that are grouped inside an ETF. Then we have momentum, probably the one I disagree with the most. Momentum meaning purely based on price movement. So we're grouping companies in an ETF because in the last 6 or 12 months, the stock price went up. And so there are momentum stocks, essentially. So the momentum is good for these companies, regardless of the financials or prospects of the business, of the underlying. It's just the stock went up, so therefore it's a momentum stock. So therefore apparently we should own it because it went up in the past. And that's why I fundamentally disagree with this ETF the most, or this factor investing the most. It just doesn't make sense to me, because what happened before doesn't represent what's going to happen in the future, and really you're not really taking into consideration any economic common sense approach to looking at the companies that behind it. You can have a terrible company with no sales, no profits. The stock went up for whatever reason, and it would be considered a momentum stock and would end up in this ETF. So yeah, I don't like this factor at all, but it's there. And what else do we have? Small cap. So these are small market cap companies, pretty self-explanatory. Then we have low volatility, so not a lot of volatility for these stocks, probably a lot of defensive stocks, utilities, stuff like this. And then high dividend yield, so these are the cash cow in the BCG model, right? The Coca-Colas and stuff like this that kind of peaked in terms of growth, but are basically cash registers in terms of dividend yields that they offer to their shareholders. So yeah, you could play the markets. It's a different dimension essentially to look at factor investing or looking at factors. And it's also interesting in terms of, if you're running a portfolio, to look at the factors in terms of, okay, where is the flows of funds moving, right? We're looking at money flows essentially in a new dimension. And as we can see here, in terms of these factors, the money has flowed out of most factors to go into growth in the recent years. So that's pretty interesting. What else do we have? We have another dimension, or another category, segment of quality or qualitative factors. So here we have a couple. We have buybacks, spin-offs, hedge funds, IPOs, quality, and private equity. So buybacks are the companies buying back their own shares to prop up the stock price. Then we have hedge funds, spin-offs, IPOs. I've talked in previous videos, initial public offerings. Quality. So this is based, when they say quality, they mean the quality of the balance sheet, of the financials of the company is very good. And private equity. So these are the companies that didn't go into IPO but went into the private equity route in the meantime to eventually go IPO somewhere down the line, but in the meantime they go to private equity. Now, if we compare it to the S&P 500, as you can see on the chart, IPOs there in purple had a massive run after COVID. They've outperformed the S&P 500 by more than 100%, and then crashed back down in subsequent years till today, where they are underperforming by 30%, the S&P 500. And if I just zoom out and go closer here, this one here, quality, is the only one that's been in line with the S&P 500. So companies that had good balance sheets, good financials, really were in line with the performance of the market, while all the others have underperformed. So buybacks, yeah, I'm not surprised, right? Buybacks are just a trick, okay? It's not like investors and people, participants of the financial markets, eventually figure out when boards are using tricks to prop up the stock price. And the best thing to happen to a company is that the economics are good, and you can use a lot of tricks around it to hide that fact. And the buybacks is one of them. So I'm not surprised that it's mechanically, yes, it will push up the stock price. But long term, you need to have good economics in your business. So buybacks is not going to do anything about that. So yeah, that didn't really work out. It's a minus 5% against the S&P. Then we have spin-offs. So this is when two companies split into two, underperformed as well. The private equity underperformed by 20%, and the guru ETF, so the hedge funds, underperformed by 27%. So not so much great gurus actually, after all. I guess the point here is that you can be your own hedge fund. Anybody can be a hedge fund, and yourself with your small retail trader brokerage account or your own hedge fund here, and there's no difference between you and the big guys, because obviously their performance is they have underperformed the stock market by 27%, sorry. And then we have the breakdown between size. So this is a bit more detailed. We have large cap value, large cap growth, mid cap value, mid cap core, mid cap growth, small cap value, small cap core, and small cap growth. So there is the 3-dimension, mid-sized, small size, and large size. And then overlaid you have value, growth, core. Okay, so you can see all of them under those different filters. And in the last 3 years, essentially, the only thing that has outperformed the S&P 500 has been the large cap value. Okay, so value stocks, value investing, add on top a layer of large cap stocks. Okay, and the one that has underperformed the most is the small cap growth. So literally the total opposites in all respects, because growth is the opposite of value and small is the opposite of large. So not good for smaller companies listed, and not really good for the growth side of the small cap space. So guys, I invite you to have a look at this page. It's great to have a different perspective, a different dimension, if you will, on looking at the fund flows going on in the market. And yeah, I will see you in the next video.